In February 2023, the Geological Survey of India announced the discovery of 5.9 million tons of lithium reserves in the Riyasi district of Jammu and Kashmir. This may be the seventh largest deposit of the rare element, accounting for roughly 5.7% of all the lithium reserves in the world. They are also said to be of a higher grade, 550 parts per million against the average 220 parts per million, making it highly lucrative given how lithium prices have soared in the past few years. According to the International Energy Agency, lithium prices went up more than sevenfold between the start of 2021 and May 2022. Why is lithium so important? Lithium is a soft, shiny grey metal found in the Earth's crust. Due to its ability to pack energy, it has utility across a range of sectors and has gained the moniker of white gold. It is now primarily used to build the batteries that power modern appliances. They also power electric vehicles, a segment that will corner most of the global lithium production in the future. All these years, India did not have its own lithium resources and, like crude oil, was dependent on imports. In fiscal 2022, India imported lithium and lithium ion worth almost 14,000 crores. But with the focus on green mobility, the demand for lithium in India is likely to explode in the future. What are the pitfalls of lithium mining? Just like any mining activity, there are adverse impacts on the environment, including water, soil, and air pollution. Extracting lithium from its ore is highly water intensive, taking about 2.2 million liters of water for 1 ton of lithium. The Himalayas are a highly fragile and eco-sensitive region, and as the recent Joshimath subsidence shows, it is vulnerable to long-term adverse consequences of unplanned development work. Mining in the region can attract opposition from environmentalists. Now, will this mitigate China's lithium dominance? China does not have too much lithium reserves of its own, but as the largest market for electric vehicles, it controls both the supply and demand side of the lithium industry. It controls over half the global lithium processing and almost 75% of cell components and battery cell production in the world. In effect, proliferation of EVs could mean India becomes dependent on China, just like it's reliant on the Middle East for crude oil today. Jammu and Kashmir's lithium reserves, however, provide a major opening for India to be self-reliant. In other words, the lithium gold rush in India has just begun. But apart from lithium, pretty much every metal that goes into smartphones is grabbing limelight these days. The impact of China plus one on the smartphone manufacturing sector is evident. Apple's partner Foxconn Technology plans to invest $700 million on a new plant in India to ramp up local production. This underscores an accelerating shift of manufacturing away from China as Washington-Beijing tensions grow. The Taiwanese company plans to build its new smartphone factory in the state of Karnataka. Now, it's extremely uncertain whether Foxconn will import key components of the smartphone, especially the rare metals not readily available in India. But investors expect the PLI benefits of the sector to attract massive investments, and therefore the demand for the key metals could explode. For it's not just Apple but several other US brands that are seeking alternative production units in India. It's a rethink of the global supply chain that has accelerated during the pandemic first and the Ukraine war later. There is a possibility that India becomes a global electronics manufacturing hub, and this is the key driver of the investor rush towards metals like lithium. Unlike popular perception, lithium and cobalt are just two of the many metals that go into the smartphone. So, seeking investment opportunities in the others is both complicated and speculative. Meanwhile, A boring metal that typically has few takers is showing signs of upsurge in demand. The undercurrents are so strong that the prices of the metal have gone up by almost 50% in the last 18 months. Steel prices. Steel prices in India may have been on a tear. However, globally, low demand has caused prices to crash by nearly 40% in the past year. By December 2022, prices of steel had crashed to nearly $590 per ton from the early April peaks of $1,000 per ton. The reason for the crash is primarily low demand from China. But India is expected to emerge as the savior for the flagging global steel demand. Over the next few years, China's massive construction sector may remain stagnant, and the US and Europe are likely heading into recessions. India, meanwhile, is poised to capture most of the steel demand thanks to a massive infrastructure and corporate capex boom. The Indian government is seeking to modernize roads, rail networks, and ports in an attempt to compete with China as a manufacturing hub. So, according to the World Steel Association, India's steel demand could soar to 200 million tons by 2030. This will make India the highest steel consumer amongst major economies. Add to that the demand for steel in the aftermath of earthquakes in Turkey. Rebuilding and reconstruction of Turkey after the devastating earthquakes is expected to cause global massive demand for steel. In 2021, Turkey's crude steel production exceeded 40 million tons. Of this, more than 22 million was exported, making it an important player in the world steel trade. After the earthquake, not only will the nation be unable to meet its own demand, but Turkey may also seek to import. This will stoke both volumes and prices for the largest steel producers globally. So, understandably, the undercurrents for demand of steel are much stronger than the fancier metals needed for smartphones, like lithium. The visibility is much higher in the case of steel, and Indian steel makers are much better placed to cater to the demand both domestically and for exports. So, investors should keep the fundamental demand drivers in mind rather than getting swayed by speculative bets. According to a CII report, the growth of crude steel production in India has not kept pace with the growth in capacity of production. As per this report, steel sector contributes 2% to India's GDP and employs 500,000 people directly and 2 million people indirectly. As of 2021, India was the world's second largest steel producer with 102.5 metric ton production and installed capacity of 142 metric tons. On the consumption front, India is the third largest steel consumer in the world and has finished steel consumption of nearly 95 metric tons. The sectors that have emerged as leaders in using finished steel are construction 62%, capital goods 15%, automotive 9%, and other intermediary products. In recent years, India has become a net exporter of steel as India's steel imports have been much lower. Domestic production of specialty steel was able to meet 85% of India's demand in 2021, with the balance being met through imports. Significant portion of steel import was of the specialty steel comprising high-grade alloy steel and specialty steel. So even though India is the second largest steel producer worldwide, specialty steel accounts for only 18% of the exports. The growth in steel exports is also aided by lower domestic demand and foreign trade agreements that India has with countries like Japan and South Korea. While countries like Japan and South Korea export value-added steel products to India, markets like the EU and US have protectionist policies like quota restrictions, and Middle East is also considering the same. India has also formulated policies aiming at bolstering the domestic steel sector, And some of these policies are the National Steel Policy 2017, Steel Scrap Policy, Domestically Manufactured Iron and Steel Products Policy, etc. The government has also rolled out the Production Linked Incentive (PLI) scheme for the specialty steel sector to ensure raw material security for the sector, particularly focused on iron ore and coal. If you take into account the financials of the top steel makers in the country, the key concerning factors are the level of debt on their books, the free cash flow, the return ratios of the companies over several cycles. An additional point to take into account is the working capital cycle of the companies and their respective asset turnover ratios. So, even though the stocks may be available closer to their book value, being careful of the balance sheet risk could help avoid value traps. Yet another way to evaluate the valuation multiples of the Indian steel makers is to compare them with their global peers. Since steel is a commodity that is traded globally, a comparison with international peers could give a fair idea of the upside in prices. For instance, like we can see here, the Indian steel makers seem fairly valued when compared to their American counterparts. However, their valuations seem expensive when compared to other Asian and European steel majors. To delve deeper into the fundamentals of the best steel stocks to have in your watch list, the Equity Master Screener can be a very useful tool. Hope you like this video. Thanks for watching.